Hello and welcome to Edison TV. I'm Miłosz Paps, Director of Investment Trust Content at Edison, and today I'm joined by Gaurav Narain, who is managing the India Capital Growth Fund. Gaurav, thanks for joining us today.
Thank you.
Can you maybe start by discussing why should investors consider investing in India specifically as opposed to a broader emerging market fund or any of the other fast-growing Asian markets?
Well, I think that India's changed a lot, and it's really one of, I would say, the fastest growing economies globally. And it's really not just a one-off growth story that you see. In fact, if you go back in time, India's actually, over a decade itself, India's delivered a nominal GDP growth of over 10 odd percent. And the way the economy has transformed and changed, our belief is that, you're actually looking at a similar growth, if not higher, going for the next 5 to 7 years at least. And a lot of changes have happened, which is why we believe that, you should look at India from a longer term perspective. One is that, India's actually had a fairly stable government at the top. We've had a decade of a single party having a majority rule. And they've been able to, it's a very development focused government, looking at really, looking at India from a longer term perspective and really taking it to where it should move. So they've done a lot, right? From a lot of reforms, bringing about transparency, building out a lot of physical infrastructure, a lot of digital infrastructure, to the extent that India has actually now become a fairly efficient economy. And it has size. It is today the largest in terms of population ahead of even China and the youngest population in the world. So what we've actually seen over the last decade is very strong changes on the regulatory side and transparency. And today the entire focus is on growth. So, to give a perspective, you have an infrastructure pipeline of over $1.5 trillion. You have a lot of incentives which have been given to the private sector to set up manufacturing facilities. The market is there. India is one of the largest markets in terms of a lot of sectors where we import a lot. Geopolitics is favoring you because people are trying to shift manufacturing out of China. And it's a very well-educated population. It's an English-speaking population and a fairly well-regulated market itself. So what we've actually seen is the high degree of confidence that the economy is going to sustain growth because of all the changes that have already happened. It's not about what you're forecasting. It's, this is done and dusted, and you're seeing that in numbers. I mean, where will you find an economy where possibly banks are sitting, I take balance sheets of corporate India, banks are sitting on the best ever asset quality. Corporates leverage levels are low, profitability is at all-time highs, and you have investments happening. To give perspective, take just numbers, your credit growth is running at a decadal high of 16%. Order book of companies are at decadal highs. And there's a demographics also playing out where you have 1.4 billion people, youngest population in the world, 10 million people getting into the workforce every year. So, I think all the ingredients are in place and you're seeing that in numbers. In fact, the previous year, your GDP would have ended at almost an 8% GDP growth on real GDP growth. So that's really what's happening, that a lot of things have fallen in place today for India. And despite the global environment where it is today and the uncertainty, there's a very high degree of confidence in India that, the domestic itself is carrying your growth forward. So a long answer to a short question, but
No, thank you. That's actually very, very helpful. You've obviously touched upon the role of the local government and the stability, which obviously facilitated reforms, etc. Is there anything else which investors should keep in mind when thinking about the role of the local government in driving the long-term growth going forward?
you see, historically, India is a democratic country, and it is, it's a federal economy where you have powers with the central government and state government. But what's happened over time is that, the whole focus of governments have been to try and bring about transparency and reduce the role of government. So a lot of reforms when I talk about is really to reduce that interference. And what we found over time is, historically politics was all about caste and religion. Today that's changed because to be elected, it's all about generating employment. So irrespective of which government comes into play at the central government or at the state level, the whole focus is on development and how to generate employment. So that's the big change that's happened. That interference has come down, processes are better. You have very strong regulators at the capital markets as well as the central bank, and it's even on the judiciary is free. It's a very unbiased judiciary as well. So really, that's what's changed. That irrespective of which the government comes into play, you know that the direction is the same. The pace may alter here and there because of different interests, but directionally we've seen that you're heading in one way.
Thank you. That's very interesting. And in this context, maybe you can discuss your investment approach and maybe also some recent transactions within the portfolio.
So we are actually a very bottom-up stock picker. We invest in the mid and small cap segment of the market, which means you really need to be on the ground. The fact is that India is a very it's a fairly mature market in the sense it has 100-year plus history, and you have a lot of listed companies. There are over 4,000 odd listed companies. But even the investable universe, you'd say, which are liquid enough, you'll still have 700 to 800 companies in India. And so really our job is to really try and find companies which meet our criteria. And what is our real criteria is that we are very focused on investing for the long term. So typically I would say almost 60% of stocks in our portfolio we've held for over 5 years. So what are we really looking for? Our belief is that there's no shortage of growth in India. So what are we looking at is businesses which have high quality managements, where there are no governance issues at all. Where on the business itself, we're looking at business which are scalable, but have some form of an entry barrier or USP, which gives it that pricing power. And the third is we're very cash flow focused and return on capital employed focused. So, we have a threshold minimum return on capital employed below which we will not invest in those businesses. So that's how really we built our portfolio. Our whole idea of a portfolio is that you should have these compounders in your portfolio where the earnings itself compound at 15 to 20% per annum. And all you're really looking for is identifying such businesses and try and get it at a price which is below the fair value. And then you just ride it over. So we find a lot of opportunities in India. It's just that it's also a very, very competitive market. So you really have to be on the ground to be able to be early on the game. And it requires a lot of diligence as well that, you have to visit these companies, get a lot of external views on governance, etc. But I think there's a lot of opportunities in India, and the opportunity set is only increasing.
Thank you. That's very helpful. Now, obviously, you've mentioned that you have a bottom-up approach, and I understand that your active sector positions are the result of this bottom-up process. But maybe you can give us some color on your sector exposures. I understand that currently your active weights include an overweight position in industrials, healthcare, and consumer discretionary, an underweight materials, and no exposure to energy and utility stocks. So maybe you can talk us through how this reflects the set of opportunities you see at the moment.
Yeah. So as I mentioned, we are looking at the long term. So we have what we call a negative list. And the first is wherever we have governance issues. Second is, we don't look at businesses which are too dependent on government orders. Third is we try and not get into businesses which are very complex or even businesses which are so global and B2C consumer businesses globally, where we have to take a view on what's happening in China and what's happening in the US. So really, that really boils down to, buying businesses where we find we have a lot of control and predictability on the earnings side. So by default, I would say our largest exposure has always been in the consumption space because, we find that, India is a consumption. I mean, the sort of demographics are such that, business will keep compounding over time. And you have a whole range of great businesses there. I think the other large exposure we always have is on the banking side, where it's really not in the government-owned bank, but the private sector banks. because here also, it's just the growth, and it's a de facto play on the growth we see. I think other than that, it's really very, those are the two broad sector allocations. But I would say the rest is all, individual companies. So say in the auto and also ancillary space, we have four different companies, which may add to 10 odd % weight. We have some specialty chemical companies, healthcare companies, uh, and of course, as you mentioned, we also have industrials, which are really taking the play on the big sort of capex boom that's happening in India. But the key characteristics across all is that these are businesses which generate free cash. These are businesses where we are seeing earnings compound over time, very well run and managed businesses. And I'd like to add that though we play in the, say, mid and small cap space, I think most of the business we own are leaders in their subsegments of the market, or have some niche positioning which gives them that edge. So I would say it's broadly diversified, but very, very, as I said, we really don't go from a top-down approach, but really go from a bottom-up way of picking our stocks.
Thank you. Thank you. That's very helpful. And finally, well, some investors consider the Indian market expensive at the moment. Do you share this view?
No, that's a fact. I think India's done exceptionally well over the last 3 years. And simply because, as I mentioned, there is growth happening. You're seeing it visible in the earnings. The direction you're seeing, the order books of companies you're seeing, you get a lot of comfort that this is there for the longer term. More importantly, I think the regulatory environment is such that on governance and even on excesses, a lot of it is being controlled because the banking regulator, etc., are very rigid and trying to ensure that excesses don't happen. So I would say there's a lot of confidence and comfort in that sense, but that's getting reflected in the valuations, frankly. And I would say today the market is trading at close to its all-time highs. I think if you look at it, it's similar to the US market. The broad market multiple is at about 20 times 1 year forward earnings. But if you really look at the great quality businesses you want to buy, where you have a lot of comfort on that sustainability, I would say they are expensive. So I think, but how I would look at it is that don't go by 1 year earnings. And the reason behind that is that the growth is fairly sustainable. And so really the key factor to look out for is that are you confident on the company's ability to deliver on earnings growth? So the moment you go beyond that 1 year, suddenly the valuations again start looking in a bit of a comfort zone. But having said that, it's not an easy market. I think valuations are clearly not cheap, but there is growth. And so how I'm looking at it is that, you got to be very sure that the earnings will deliver, because if the earnings are delivering, then I would say just the time will bail you out. But, I would look at it, India, if you look at India's valuations over the last 2 odd decades, every 5 year period, you've actually seen the structural valuations move up, and largely because of, I would guess it's the market is getting more mature and delivering on returns as well. I think what I'd like to add is also it's a very diverse market, and it's a fairly capital efficient market. So if you really look at India versus emerging markets, India would always have the highest return on capital employed or return on equity in the market. And the reason behind is that capital has always been scarce. So managements have always valued capital. And the nature of the market is also different, that it's not a very commodity heavy market. It's a very diversified market with consumer, IT, a whole range of very efficient businesses dominating the market.
Gaurav Narain, manager of the India Capital Growth Fund. Thank you very much for the insightful conversation.
Thank you. You're most welcome.